Selling covered calls is the opposite of selling puts. You're selling calls, and they're called covered calls because you need to cover them with either 100 shares, which is the amount of one contract, or you can cover them with a bought option contract. Let's say, I'm not sure if y'all ever heard of leaps. Leaps are long equity anticipated. I forgot what the S is, but leaps are basically when people buy calls for a year out or 2 years out, and they're expecting that the price will come up, but they buy these contracts far out in the future. Those are called leaps. So when you sell a call when you're expecting price to go down. Sell a call when you're expecting price to go down. Okay, so the steps for selling covered calls. Okay, you buy or you own. If you already own 100 shares of something, you don't have to buy it. But if you don't, you can buy 100 shares of a stock that you like. We're going to go back to barchart.com again so we can see some choices. You want to chart the stock on the daily time frame. Not as important. Charting is not as important with covered calls as it is for puts, and I'll show you why. You want to select a call strike above the current price and above your resistance zone or above what you paid for the stock. All right, you go to the option chain, put it on single, select the expiration date you want. You want to pick the bid column of the strike you want on the call side because we're selling a covered call, and then you collect your premiums. We're going to go through lots of examples here, so you're going to be able to see how this goes. And at some point you exit this trade. You can let them expire worthless if you want, or you can close it on your own, just like you did with puts. You go to the monitor tab like we've showed you before, click on it. Then you're going to close the order, do a closing order. Remember, if you sell to open, then you need to buy to close. The price you want to pay to exit will populate. If you're okay with that, you click confirm. If not, you input what you want. Let's go to Barchart first and look at what would be some good opportunities. Okay, so we're at Barchart and we go under options. You select this. Under here, you got covered calls. We looked at naked puts the other day. Oh, where you going, Barchart? There we go. We looked at naked puts the other day, but today we're going to look at covered calls. Selecting covered calls. This is a free screener that will provide you covered calls on different stocks that are providing really good premiums. This is what it has whatever the criteria is. It shows here what the ones that will provide you some decent little premiums. So we're looking here. We've got the stock here in the front, here, the stock at the first column. They tell you which strike that you may want to look at. This is the current price at the time that they ran the screener. This is the price of that stock at the time, right? And if you go across, they say bid, this is the amount of money that you're going to take in premiums if you decide you're going to run this trade, and you do your expiration date. You do all the stuff they say there. Of course, by the time the market usually reopens, some of these things have changed, but you can still have time to look and see if there's any interest there. Now, when you're buying covered calls, if you're buying shares, you need to buy 100 shares. You need to buy, if you're going to do this strategy with covered calls and you don't already have the shares, you've got to buy them. So you look at things like, maybe a BPT. This is going to be $600 worth of shares you're going to have to buy, right? If you look at WTI down here at the bottom, this is going to be $400 worth of stock. And you can see, if you decide you like Mara's going to be $955 worth of stock. Now, the good thing is when you buy 100 shares of this company, you have 100 shares. Nobody can take that away from you. You can use it. You can hold on to it. It goes up, it goes down. Hopefully it goes up more than it goes down. but they're yours, and you can use these shares to sell covered calls over and over and over, right? CDLX is another one. This is going to cost you $815 in shares if you decide you're going to buy the shares. Let me go see if I can scroll down and see if we see some other ones that are not as expensive. So I think we looked at that, what, EOSE the other day. What is I'm thinking, what is the price of EOSE? I want to say it's about $2. I think we looked at EOSE the other day, and price of EOSE is $1.72. Okay, so if you were going to buy 100 shares of EOSE, you're going to pay $172. Okay, are we clear on how we how do we start the process? We start by buying or owning 100 shares of the one that we're going to use. Real quick, I just wanted to come on. This is Arlissa, Educator to Trader. Wanted to come on and tell you and ask you, I guess, to like and subscribe to the channel. If you like the content that I create and I'm, posting regularly, then go ahead and subscribe. That way you won't miss anything and you can be a part of all that we're doing here. I'm a coach to sellers. I'm an option sellers coach. If that's a vein that you don't know anything about or you want to know more about, then go ahead, subscribe, and check us out all the time. All right. Thank y'all. I appreciate it. We can look also at one more. We can look also at one more for $4.85 for, so that's about $485 is what you would pay for 100 shares of SoFi. Okay, so now what do we do with these 100 shares that we have? Let's go into our on demand and see how do we work the process of managing our covered calls. Now, again, this can be done with any stock you like. As your resources improve, you might decide, I really like stocks that are more expensive. You may decide, like I said, you might want to do Mara or Riot. They're $9 and $10. Of course, if you're doing something like an Apple, it's $100 stock, 100 and some change. So when you 100 and some change. So if you're going to do something like Apple, you're going to have to take that $100, multiply by 100 shares. So that becomes $10,000 worth of stock that you're buying. Okay. EOSE, are we there? Yep, we are. When we're working with covered calls, first thing you're going to do, first step is you're going to buy the stock. How do we buy the stock? Well, up here where it says B and A. And I think if you're on the, I think if you're even on the chart area inside of your app, there's a bid and ask at the top. I know on Robinhood it's there. I don't know if anybody's buying any shares in Robinhood at this point, but I'm going to show you what I'm talking about. Most of us now are using Thinkorswim, and I think in Webull though, Miss Jackie, if you see where it says bid and ask, this is where you can buy the stocks. You can buy the shares. Okay. Should be at the top. Usually it's at the top, and the app looks a little bit different, of course, on Thinkorswim than the app looks a little bit different than the desktop looks. When you're using it on your phone or using it on your tablet, it's going to look a little bit different. EOSE, there we go. I just want to show you where it is in Robinhood in case you decide you're going to buy. But the bid and the ask is basically the two between these two places is where the price is. Robinhood's taking forever. Let's go back. Oh, it finally popped up. So you got here, the price is $1.76, right? And if you want to buy EOSE over here in Robinhood, you just can buy how many shares you want. You can buy in shares or you can buy in money. Robinhood allows you to buy partial shares. Some companies like Thinkorswim, you have to buy whole shares. You can't buy portions, but Robinhood allows you to work with partial shares. Okay, So you can buy however many you want. If you were buying, 100 shares, it's $1.76. Estimated cost is going to be $176. When we're here back on Thinkorswim, we're going to buy these in our on demand. I'm going to select this B and A, which is the bid and ask. I think you can also buy them from the chart. There's a few different places, but here you see buy. I picked the bid, the BA up here next to the price, and I think I might have been able to pick anywhere up in this box. You could have picked the price right here at $1.66, and then a drop down happens. You can say buy. I want to buy them at $1.67 a piece, and it automatically populates with 100 shares. You can, of course, change this number to whatever you want to change it to. But in our case, we're buying 100 shares at $1.67. We're going to confirm and send. Okay, we bought 100 shares. Let's also go buy us some more stuff. In the sim, you're a millionaire. You can buy anything you want in the sim. You can buy anything you want in the sim. I'm going to buy some AMC. $5.37. We're getting 100 shares here. We're balling out today, boy. We're going shopping. We're going shopping in the stock market. Okay. I'm also going to go and buy 100 shares of my darling. Okay. So we're going to go to, we've got them in our accounts. We done bought some AMC, EOSC. Well, I'm not sure why FRC is still here. I must have been fooled. That was from the other day, I think, when we were messing around. So I got AMC, EOSC, and SoFi. Okay. So you see here, we own 100 shares. Oh, that was a put from the other day. We own 100 shares. Now we're ready to go trade and do some covered calls. We're on the trade screen and we do single. Trade screen and single. Okay, we're looking on the call side because we are selling a covered call. So we bought our shares on the 28th, which was, the same day we're on. Remember, we're doing on demand. So now let's look at what kind of premiums we would get. We paid, you got to look here to see how much did we pay for our AMC shares. Okay, under trade price, it tells you we paid $5.38 for our shares. Okay, so when you're doing a covered call, you want to sell a covered call above what you paid. You want to sell a covered call above what you paid. So if you paid $5.38 for it, you want to sell a call. We're on the call side. You want to sell a call at $5.56, $6.50, whatever, as long as it's above current price and above what you paid for them. How did I get to SoFi when I was talking about AMC? Let's go here, AMC. Okay, we want to sell a call above what we paid, because the reason I say this, okay, we paid $5.38 for them. If you're selling a covered call and the price goes up into that and breaches it, then the stops are going to be called away. And you want them to be called away higher than what you paid. You don't want to do a 5 strike and then your shares get called away for $5 a piece, which is $500, but you paid $5.38, right? So you have to pick a strike price. You have to pick a strike price higher than what you paid. You can go up to $5.50, $6, because if the price goes up, then you would release your shares for $5.50, or you would release your shares for $6 each. Well, you only paid $5.38. So you want to make back more than what you paid. That's with anything, right? You don't want to go, you selling stuff, you buy it at one price, you sell it higher. And now we're going to look at selling a covered call, but you need to know how much you paid for them first, because you don't want to pick something lower than that. And then then you end up having your shares called away for a price lower than what you paid for.
Mhm.
Okay, so I'm looking at 1 week away, May the 5th, and we need to be above 538. So we can look at the 550 strike. We can look at $6 if we want. Notice how much you're gonna take in premiums. If you go with the 550 strike, 1 week away, you're gonna collect $20 in premiums. If you go with the 6 strike, you're gonna collect $10 in premium. Keep in mind, you still have the asset. You still have 100 shares of AMC stock at $5.38 a piece. On top of that, you're going to get $20 in premiums.
Mhm.
Okay. And if the price at expiration goes up higher than your 550, the shares will be called away. This is how the wheel works. So let's say we're going to do a 5.5 strike. I need to put it on the thing. I need more room. Let me share the whiteboard. Oop, we're pulling out the whiteboard. Okay. So with covered calls, we paid $5.38 per share. If we're going to pick the 5.5 call, make sure we pick the bid, and we're going to collect $20. Okay. If at expiration price is below, if price at expiration is below 550, we basically win the trade. Okay, we win the trade and keep our shares. If the price is below 550 at expiration, then you win the trade and you keep your shares. Are you with me so far?
Yes.
Okay. If price is above 550 at expiration, your shares will be called away. At $5.50 each. At $5, remember, you paid $538 is what you paid for them, but you will receive, but you're gonna get $550. So the difference between that is you're going to have $12 of profit in addition to the $20 you had over here, because nobody's taking those premiums back from you. You're keeping those. Okay, you won't have the shares anymore, but they've been called away at a price higher than what you paid for them, and the difference between those two is your money, and you keep the premiums that you collected. So let's say, for example, you paid $538 a share. Like, again, we paid our $538 for them, which is what we did. And let's say we choose a 6 strike price. Okay. Let's say we choose that other one. I think if we chose the 6 strike price, it was $10 in premiums is what we were going to get.
Yeah.
If price is below $6, what happens? At expiration.
You get to keep the profit and your shares.
Yes, exactly. You keep the premiums, you keep the $10 and your shares. If price is above $6, what happens?
You lose your shares, but you keep the profit and the premium.
Okay, so how much do you lose your shares at? At what price?
The amount, the strike price.
Yes, so you basically are going to sell your shares for $600, which is the $6 times the 100. You're selling your shares for $600 and you keep the $10. Okay, so if you collected 600, but you paid 538, what kind of profit is that? What, $62?
Yeah.
$62 of profit plus the $10 you collected in premiums, which means you got a $72 in profit if the price goes above $6 at expiration.
Got it.
Okay, so either you keep your shares and the premiums that you collected, or you release your shares at a higher price than what you paid, which is why it's important to make sure that you pick a strike price above your cost basis. So if the price goes up and they get called away, you at least be making money off the shares. You can also, and we looked at just 1 week out. Of course, you could go out, 2 weeks, different premiums go out a little further. If we went out here and did 2 weeks away and did the 5.5, then we're going to collect more premiums for the 5.5 and the 6. You don't have to do it week to week. You can do 2 weeks out or 3, because this is your asset. You can use your shares and sell covered calls against them out, a couple weeks, 3 weeks, or what is up to you. Honestly, if you're doing covered calls just for income, you don't care if that they get called away. The whole thing you want more money than what you paid. So if you're doing it for income, you want to rinse and repeat this as many times as you'd like. You want to buy them at one price, sell them for something higher, and let them get called away. You can do covered calls. If they get called away, great. If they don't, great. You just run it again. Hey, thanks for riding with us this far in the covered calls video. So glad you decided to spend some time with us and learning how to do covered calls. Hey, I want you to know that at educatortotrader.com, we have all of our courses: covered calls, cash secure puts, credit spreads, debit spreads, shorting, how to use SPX, how to use XSP for daily money with the 0 DTE strategy. I mean, all the things are there. So feel free to go over to educatortotrader.com and check out what we have over there. We also have a membership where we hang out together each day and we trade together in a nice, supportive community. And listen, trading can be a very lonely thing to do, and we don't want anybody going it alone. We're better together, as they say. All right, so I'm going to let you get back to the covered calls video, and feel free to send me a message if you like. Put something in the comments. I usually answer my comments. All right, back to the movie. I'm going to go with AMC. Still there. We paid $520, $538, and I'm going to go with $550, again, higher than what we paid for them. And I'm going to select the bid column. We're on single and bid. And then it says here that we're selling one contract of AMC at the 5.5 strike. We're going to collect $28 for them when we do this. So we paid $538. They're going to give us $28 back. So now our stop only costs us $510. Oh, come on. Where's my mouse?
Can you repeat that, please?
If you paid $538 for them, but then you collect $28 in premiums, you've really only paid $510.
Okay.
Yeah, because you collected some money along the way.
Okay.
Okay. We're going to confirm and send. Hooly high. What was our next one? EOSE. Let's go look and see what's our cost basis for our next one. EOSE. How much did we pay for these?
the dollar in, well, wait a minute. Is it the $1.66?
The trade price is what we paid for it. We're paying $1.60. We paid $1.66 per share, which is $166 is what we paid for our 100 shares of EOSE. What strike should we pick for our covered call?
It's like anything over the $1.66. So
Anything over
maybe
$1.66.
$2.
Now we can go to the option chain. Make sure that we go look. You just want to be, you want to be above your $1.66.
Mm-hmm.
Okay. So we're looking at May the 5th. We could go with the 2. We could go at 2.5, but what's wrong with this picture? There ain't no money, baby. There's a 0 there. There's no money to collect on those strikes. Price is $1.62. So if there's no money, you can't trade what's not there. Right? So that means we need to go out further in time. And this is something you see when you're dealing with lower price stocks. You'll have, there may not be as much volume, or there may not be the strikes you're looking for. Here we got the 2 strike here. Still doesn't have any money. No bueno. Means we got to go out May 19th. Where's the rest of these? Is this all of them? Where our stuff at? Oh, it only wants you to go to 2.5 after that. And if you pick a 2.5 strike, 2.5 strike, which is above what we paid, we paid $166. Going above that is going to give us $10 return on our investment. Okay, let's talk about the 2.5. What does that mean for us? Okay, so we kept our $10.
Right.
And our shares.
Yes.
If the price is above 2.5, what happens? So your shares are sold for $2.50 and you keep your $10. If the shares are sold for $2.50, what kind of profit is that? $2.50 minus $166 is what? $84. That 5 gets borrowed. So $84 of profit is what you're going to get to have your shares called away, plus your $10 from these premiums that you collected.
And
so you end up with $94 of profits. Okay. So when you're selling a covered call, you can go to Barchart, find you some stocks if you're interested, or just have stocks that you like. You want to chart the stock on the, I don't really think you have to chart it on the daily time frame, to be honest. You just want to be sure that you select a strike above. I'm going to say you should select a strike that's above what you paid for the stock, above the current price and what you paid for the stock, which is really called your cost basis. Cost basis is what is your cost, huh?
On the okay, so on Barchart, if you pick a stock on Barchart, they actually give you a recommended strike.
They
so
do.
You can use that or something in that neighborhood.
Yep, you can use that, because they also give you Barchart also gives you an expiration date. It's only because this is the freebie, it's only going to give you the expiration dates that are the monthly expirations. It's going to give you May 19th, which every month, the monthly options expire on the 3rd Friday of every month.
Okay.
So Barchart's only going to offer you those dates. If you pay for Barchart, it's going to give you the weekly options. But if you don't, notice how all these say either 6/16 or 5/19.
Okay.
Because those are the monthly expirations. So you can look at these. I would use Barchart to find a stock I like, and then I would determine when I want it to expire.
Okay.
Yeah. That's how I do that. So select a call strike above the current price and what you paid for the stock, which is your cost basis. Go to the option chain, select the expiration date you want, pick the bid column of the strike you want on the call side, and collect your premiums. Those are the steps. You gotta have your 100 shares, or you gotta have a long call. And again, I don't recommend you do it with the long call because it can get confusing. If the price breaches it, it gets confusing. So Barchart is a place you can look for screeners or get stocks you just like. Pick a call strike above the current price, go to the option chain, pick your expiration date, click the bid column, collect your money. When you're ready to exit this trade, you can exit covered calls whenever you want to. It says here, you can either let it expire worthless or wait to have your shares called away if it passes your strike, or you can buy it back. You can close it on your own if you want. You don't have to wait till expiration. If the trade gets to where it's worthless, you're ready to close it, you can close it whenever you want to. You want to go to the monitor tab, which is where your positions are. I think if you're on your phone, using their phone on Thinkorswim, you're going to select positions. But if you're on the desktop app, it's going to be monitor.
Okay.
You want to select the line the trade is on. You want to right click that line to create your closing order. Then you're going to buy it back. The price you pay to exit will populate in the box. If you're okay with that, you confirm and send. I'm going to go look at one of those, the ones we just did today. So we opened up our, let me go down here to SoFi so it won't be confusing because that AMC has another trade that's running in there. Okay, there we go. So this is the covered call that we just opened on this line here. If I click on this line, it turns it blue. Once it's blue, it's basically highlighted. I can right click in this area and it brings up a drop down box. So I highlighted it, made it blue. Right click on it, and I'm going to create the closing order. Just like we did on the other trades, create the closing order. This basically says I'm going to buy one SoFi call at $16. I'm basically going to buy back what I sold. Remember, when you open something, you sell to open. And you do the opposite thing to close it. So if I sell to open, which is this -1, then I need to buy to close. Create your closing order. I would slide over here and select this, not that. What are you doing? Okay, so let me right click and create a closing order, slide over here and pick it. Then the order pops up, the order entry pops up. Got a +1, now it's green. Notice it's green, that's because we're buying now, we're buying back. It says I got a SoFi, got the call, and it's gonna cost me $16 to buy it back. If I wanted to close it whenever but if I don't like 16, I decide I really want to buy it, but I'm not willing to buy it until it gets down to $10. Remember, when you're selling, you want price to go down. If I say I'm fine with buying it back, but I don't want to buy it back till $10, I can put in this order, change day to good till canceled, and then this order will actually sit in the working queue. I'm back to monitor. It'll sit in the working area. This says working. It'll sit there until the price gets to where I want it to be. See here, it says the price that I want is $10 limit, but the current price is the mark. Basically, it's currently worth $16.50. And I'm saying I don't want to buy it back till it's worth $10. I want to buy cheaper. So that order just sits there until the price gets down to my $10. If the price doesn't get there, it doesn't feel. If the price goes there, it will feel when it gets down to my price. Okay, that's your close order. How do we close these? You go to what you want. If I was picking EOSE, I'm going to select it, turn it blue. Let me turn this one off. And then I want to right click it, create closing order. I'm going to buy back at this price. It pops it up as green because I'm buying to close. It says all the right stuff here. And what do I want to pay? Maybe I say I want to pay $10 to buy it back again. I don't want to pay $20. Good till canceled. I can put this order in and it'll sit there until it's ready, till the price gets to the same spot. Okay, that's how we close an order. All right, so this has been a full view of covered calls, everything from start to finish, the entire process. Where do you find your stocks? How do you enter them? How do you exit them? What are you looking for? What does the money look like? Everything was included. I sure hope you got great value out of this video. And please be sure to like and subscribe, of course, and check the other videos on our channel about covered calls, cash secure puts, credit spreads. We do all things sellers here. All righty. Thanks for hanging out. And in this community, we do two things. We stay green and we get this money. Bye-bye.